Imagine placing 1,000 people in front of the exact same chart. They all see the same price movement. They all read the same news headlines. They all have access to the same economic reports, the same YouTube videos, the same Twitter posts, and the same market data. Yet, a year later, their results couldn't be more different. Some have multiplied their wealth, some have barely broken even. Many have lost a significant portion of their savings. How can that be? If everyone had access to the same information, then information alone clearly wasn't the deciding factor. This is one of the biggest misconceptions in investing. Most people believe they fail because they don't know enough. They assume someone else possesses a secret indicator, a better strategy, or privileged information that explains their success. But what if that's not true? What if the real battle isn't between you and the market? What if it's between your rational mind and your emotional brain? Welcome to one of the most overlooked truths in finance. Psychology always dominates every market. Whether you're trading stocks, investing in real estate, buying gold, or navigating the highly volatile world of cryptocurrency, the market doesn't simply test your knowledge. It tests your ability to remain calm when everyone else is losing control. That distinction changes everything. Today, information has become one of the cheapest resources in the world. A few decades ago, professional investors had enormous advantages because they could access data that ordinary people simply couldn't obtain. That world no longer exists. Today, with a smartphone and an internet connection, almost anyone can learn how Bitcoin works, understand inflation, study Warren Buffett's investment philosophy, or watch thousands of hours of educational content completely free. Knowledge has become democratized, yet financial success remains incredibly rare. If information alone created wealth, every person watching financial videos every evening would eventually become wealthy. If reading books guaranteed success, every bookstore customer would retire rich. If market analysis alone worked, every analyst would outperform the market. Clearly, something else is happening. When people lose money, their first instinct is almost always the same. I need to learn more. I need a better trading system. I need a more accurate indicator. I need artificial intelligence to help me. I need another mentor. These responses sound logical, but almost nobody asks the much harder question. If I already knew the correct thing to do, why didn't I do it? That single question reveals the uncomfortable truth. Knowing and doing are completely different skills. Think about exercise. Almost everyone understands that regular exercise improves health. Almost everyone knows vegetables are healthier than fast food. Almost everyone understands that sleeping 8 hours is beneficial. Yet millions of intelligent people fail to follow these simple principles every day. Not because they lack information, because human behavior is driven far more by emotion than by knowledge. Investing works exactly the same way. Every experienced investor knows they should avoid panic selling during market crashes. Yet every major crash in history has been accompanied by millions of people doing exactly that. Everyone says they want to buy assets when prices are low. Yet when prices actually collapse, fear suddenly becomes stronger than logic. People who spent years waiting for cheaper prices suddenly refuse to buy because they become convinced the market will fall forever. Nothing about the investment opportunity changed as dramatically as their emotions did. The opposite happens during bull markets. When prices rise relentlessly, caution quietly disappears. People begin believing that this time is different. Every correction feels impossible. Every asset appears destined to rise forever. Suddenly, investors who once demanded evidence become willing to buy almost anything. Projects with no revenue, companies with no profits, cryptocurrencies with no utility, ideas with no foundation. The higher prices climb, the easier it becomes to believe even the most unrealistic stories. Notice something fascinating. The facts often change very little. The emotional interpretation changes dramatically. This is why market cycles repeat generation after generation. Technology evolves, financial products evolve, artificial intelligence evolves, but human psychology barely changes. The fear that investors experienced during the Great Depression isn't fundamentally different from the fear experienced during the 2008 financial crisis. The excitement surrounding the dot-com bubble wasn't very different from the excitement surrounding meme stocks or speculative cryptocurrencies decades later. Different assets, different technologies, the same human brain. This happens because our brains were never designed for investing. For nearly all of human history, survival, not wealth creation, was the primary objective. Imagine living tens of thousands of years ago. If your tribe suddenly started running, stopping to analyze the situation could get you killed. Following the crowd increased your chances of survival. Reacting immediately to danger kept you alive. Avoiding painful losses mattered more than pursuing uncertain rewards. These instincts helped humanity survive. But financial markets reward almost the opposite behavior. Markets often reward patience, while our brains demand immediate action. Markets reward independent thinking, while our instincts encourage following the crowd. Markets reward emotional stability, while our biology prepares us to react emotionally. This creates an invisible conflict inside every investor. Your logical brain may understand that temporary volatility is normal, but another part of your mind interprets falling prices as immediate danger. Your logical brain knows that long-term investing requires patience. Yet your emotions constantly whisper that you should do something, anything, to escape uncertainty. This is why many investors make decisions they later regret. Not because they are unintelligent, because they are human. Psychologists have spent decades studying one particular phenomenon known as loss aversion. The basic idea is surprisingly simple. Losing $1,000 feels significantly more painful than gaining $1,000 feels pleasurable. The emotional impact isn't symmetrical. Pain carries greater psychological weight than pleasure. Now think about what financial markets demand. Successful investing often requires accepting temporary losses in pursuit of larger long-term gains. Your investment might decline 20% before eventually doubling. Your portfolio might experience frightening volatility even while your long-term thesis remains completely intact. Logically, this makes sense. Emotionally, it feels unbearable. That's why so many people abandon good investments for bad emotional reasons. They mistake discomfort for danger. But discomfort and danger are not the same thing. Consider cryptocurrency as an example. Every major Bitcoin bull market has been preceded by periods during which investors questioned whether Bitcoin was finished forever. Every major decline generated headlines declaring its death. Every recovery eventually produced headlines claiming that Bitcoin would only go higher. The asset changed. The headlines changed. The emotions repeated almost perfectly. Fear convinced people to sell near the bottom. Excitement convinced others to buy near the top. Neither decision was driven primarily by analysis. Both were driven by psychology. This pattern exists far beyond crypto. It exists in stock markets. It exists in housing markets. It exists in commodities. It exists in business decisions. It even exists in everyday life. People often believe confidence means certainty. In reality, confidence usually peaks precisely when risk becomes greatest. Likewise, despair often reaches its highest point just before opportunities quietly begin appearing. Markets have a remarkable way of exposing emotional extremes. This is why investing is one of the few professions where intelligence alone offers no guarantee of success. Some of the brightest people in the world have made catastrophic investment decisions. Meanwhile, individuals with average intelligence but extraordinary emotional discipline have quietly built enormous wealth over decades. The difference rarely comes from predicting the future more accurately. It comes from reacting to uncertainty more effectively. Every market is ultimately a mirror. It reflects not only economic conditions, but also human emotions: greed, fear, hope, regret, impatience, overconfidence. These invisible forces influence billions of dollars every single day. And whether we acknowledge it or not, they influence us as well. The market doesn't care how many books you've read. It doesn't reward confidence. It doesn't punish ignorance. It simply responds to the collective decisions made by millions of emotional human beings. Which leads us to a profound realization. Perhaps the greatest challenge in investing isn't finding the perfect strategy. Perhaps it isn't discovering hidden information. Perhaps it isn't predicting the next bull market or avoiding the next crash. Perhaps the greatest challenge is learning to recognize the invisible conversations happening inside your own mind before they silently shape every financial decision you make. Because in the end, the market doesn't defeat you. It simply magnifies every weakness you bring into it. And until you understand your own psychology, Every chart will continue to feel unpredictable, not because the market is irrational, but because your emotions will always speak louder than your knowledge. Dưới đây là phần 2, tiếp nối mạch văn và phong cách của phần 1. Imagine, for just a moment, that every human being suddenly disappeared. No traders, no investors, no hedge funds, no governments, no institutions, no retail buyers, no sellers. What would happen to the financial markets? The answer is surprisingly simple. There would be no market at all. Prices only exist because human beings assign value to something. Every candlestick on a chart represents thousands or even millions of individual decisions driven by hope, fear, confidence, uncertainty, greed, and regret. The market is often described as a machine, but that description is incomplete. The market is actually a living expression of collective human psychology. Every rally is built on growing optimism. Every bubble is fueled by expanding greed. Every crash is accelerated by spreading fear. Every recovery begins when despair quietly starts to fade. Once you understand this, something remarkable becomes clear. Price is not simply moving because of numbers. Price is moving because emotions are moving. That is why every market, regardless of the asset, follows surprisingly similar emotional cycles. Technology changes, governments change, currencies change, companies rise and disappear. Entire industries are born and become obsolete. Yet the emotional rhythm behind markets remains almost identical. First comes hope. People begin noticing an opportunity. Then optimism grows. Early investors feel rewarded. Confidence slowly turns into excitement. More people arrive. News headlines become increasingly positive. Experts appear everywhere explaining why this trend is obvious. Then comes euphoria. At this stage, people stop asking whether they should buy. Instead, they ask how much more they should buy. Risk suddenly feels invisible. Everyone seems like a genius. Every success appears permanent. This is usually the moment when psychology becomes stronger than reality. People stop evaluating value. They begin chasing momentum. Then something unexpected happens. The market stops rising, not because everyone suddenly became irrational, but because there are simply fewer buyers left than before. The first decline appears. Most investors ignore it. It's only a temporary correction. Then prices continue falling. Confidence begins to crack. People search desperately for reassuring opinions. When reassurance disappears, anxiety quietly takes its place. Soon anxiety becomes fear. Fear becomes panic. Panic becomes surrender. Assets that people refuse to sell at high prices are suddenly sold at any price available. The same people who confidently declared that an asset would never stop rising now insist it will never recover. Nothing illustrates the power of psychology more clearly than this transformation. The facts rarely change as quickly as emotions do. Nowhere is this cycle more visible than in cryptocurrency. Every Bitcoin cycle introduces millions of new investors who genuinely believe they will behave differently from those who came before them. They promise themselves they will never buy because of hype. They will never panic during volatility. They will never become emotional. They have watched countless educational videos. They understand market cycles. They know exactly what happened during previous bull markets and crashes. Yet when real money enters the equation, something fascinating happens. Knowledge quietly steps aside. Emotion takes control. As prices accelerate upward, they begin feeling that they are missing out. Friends start making money. Social media fills with screenshots of enormous profits. News headlines become impossible to ignore. Suddenly, waiting feels painful. Buying feels safe. Ironically, the greatest feeling of safety often appears when risk is highest. Then the cycle reverses. Prices begin falling. News becomes negative. Predictions become catastrophic. People who once dreamed of financial freedom suddenly begin wondering whether they should sell everything. The exact same person, the exact same asset, the exact same long-term plan. Only one thing changed: their emotional state. This is why markets continue repeating history. Not because charts possess magical patterns, not because history somehow predicts the future, but because human beings repeatedly experience the same emotional reactions under uncertainty. Fear looked the same hundreds of years ago. Greed looked the same hundreds of years ago. Regret looked the same hundreds of years ago. Our technology has evolved faster than our psychology. Artificial intelligence can analyze billions of data points within seconds. Algorithms can execute trades in milliseconds. Information travels around the world instantly. But none of these innovations remove the two most powerful forces in every market: fear and greed. These emotions still dominate decisions involving trillions of dollars every year. This leads to another uncomfortable realization. Most people spend years trying to predict what the market will do next. Very few spend the same amount of time trying to predict how they themselves will react. That may be the more important question. Can you remain patient while everyone around you becomes impatient? Can you remain disciplined when everyone else is celebrating easy profits? Can you stay calm while headlines predict financial catastrophe? Can you admit you're wrong without allowing your ego to destroy your portfolio? These questions have nothing to do with technical analysis, nothing to do with macroeconomics, nothing to do with blockchain technology. They are questions about self-awareness. Professional investors often appear mysterious because outsiders assume they possess superior information. Sometimes they do. But more often, what separates exceptional investors is remarkably simple. They understand themselves. They know when excitement is clouding their judgment. They recognize when fear is pushing them toward irrational decisions. They understand that confidence can become dangerous. They know that certainty is often an illusion. The market constantly tempts participants to react emotionally. Every sudden rally whispers, "Buy now before it's too late." Every sharp decline screams, "Sell before everything disappears." Neither message comes from the market itself. Both messages originate inside your own mind. That realization changes everything. Because once you recognize your emotions as signals rather than commands, you gain something incredibly valuable: distance. You stop reacting automatically. You begin observing your own thinking. Instead of asking, "What is everyone buying?" you ask, "Why do I suddenly feel an urgent need to buy?" Instead of asking, "Why is everyone selling?" you ask, "Am I responding to facts or to fear?" This shift may sound subtle. In reality, it transforms the entire investment process. Markets reward those who think independently. Independent thinking requires emotional independence, and emotional independence requires self-control. The goal is not to eliminate emotion. That is impossible. Emotion is part of being human. The goal is to prevent emotion from becoming your decision maker. The greatest investors in history were not fearless people. They simply refused to let fear make their decisions. They were not immune to greed. They simply recognized it before acting upon it. That is a profound difference. Ultimately, every financial market is a classroom, not a classroom that teaches mathematics, not a classroom that teaches economics, but a classroom that reveals your character. It exposes your patience, your discipline, your humility, your impulsiveness, your ability to remain rational while everyone else becomes emotional. This is why two people can own the exact same asset and experience completely different outcomes. One is controlled by the market, the other controls himself. The first constantly searches for certainty. The second accepts uncertainty as the cost of opportunity. The first blames charts, news, governments, or manipulation. The second begins by examining his own reactions. That is where lasting success begins. Because in the end, you are not really competing against millions of other investors. You are competing against the oldest instincts ever written into the human brain. You are not trading Bitcoin. You are not trading stocks. You are not trading gold. Every single day, whether you realize it or not, you are trading your own psychology. And until you learn to master your own mind, every market will continue to feel like an enemy, when in reality, it has only been reflecting the person standing in front of it all along.